Okay, chapter 5. So remember, the first exam is chapters 1, 2, and 5. I'm taking all of the stuff where you just have to read it and memorize it, and I put it together so we can get it out of the way and move on with the other stuff, right? Okay, so chapter 5. A little bit of review. A lot of the things we've already talked about, right? The whole concept behind accounting is to gather information and generate reports that are really a communication tool. To whom? Managers of the business, investors, and lenders, correct? Okay. We're focusing on the investor portion of it or the lender portion of it in this program. Hello. In this class. So, if you are a publicly traded company, meaning you sell stock on an exchange, you have to issue financial statements that are audited and conform with the rules of GAAP. You submit them to the Securities and Exchange Commission. They're the guys who set the rules for publicly traded companies. Good? Okay. So they set the rules. The FASB, remember those guys? Financial Accounting Standards Board? That's the part of, the little community of accountants that came together and set up what we call GAAP, Generally Accepted Accounting Principles. Management, here's the fun part, right? Auditors come in and they audit financial statements, and they write an opinion letter saying the statements are fairly presented. Yes? So who's responsible for those financial statements? Are the auditors? No. Technically, no. But if you were one of the big companies like Arthur Andersen that got sued, yeah, maybe you thought you were fine, right? No. Management has the responsibility for the financial statements. They prepare them. They compile the information, put it together. They give it to the auditors and say, here, test this. See if it's okay. So management is responsible. Good? Okay. So the auditors use some standards and rules set by the Public Company Accounting Oversight Board to do the audit. Every company, every publicly traded company has shareholders, right? We were talking about that over here, common stock. The shareholders get together and they elect a group of what's called board of directors. Board of directors are the guys who oversee the management of the company. The CEO works for the board of directors. He then hires everyone else in the company. Okay, so the board is basically owners of the company, or even non-owners sometimes. And they, by law now, after a lot of the Enron type stuff that went on, are required by law to have direct communication with the auditors. So there has to be an audit committee that's a subcomponent of the board of directors that is in direct contact with the auditors. Okay? Before it used to be management talked to the auditors, and then management would tell the directors, the auditor said everything's okay, you don't have to talk to them. No more. Good? Okay. This is what we just went over. Slides in there if you want to go see it. I'm not going to repeat it. Management has primary responsibility for the financials, right? The CEO works for the board. The chief financial officer has to sign off saying that he accepts responsibility for those financial statements. So if there's any graft, corruption, or misrepresentation going on, these guys go to jail. Always fun, right? Everybody loves going to prison, right? Yeah, no. Bad idea.
What if they're just honest mistakes?
Well, notice I said graft and corruption. People make mistakes, and then you go back and you correct it and you tell the world, hey, I made a mistake. That's called a revision or a republishing, and that's bad enough, okay? Everybody now assumes that you do that because you don't want to get caught for the fraud that you already did. So you don't want to have it really happen. But an honest mistake, you come tell the world, hey, I blew it. It's my fault. Here it is. I fixed it. Real quick. Okay? So again, the board represents all of the shareholders. They're elected by the shareholders. There's a subcomponent of that, the audit committee. There'll be a smaller number, and they must be in direct contact with the auditors. Good? Questions? Moving on. Independent auditors, these are the guys. CPA, they issue a report. It's a one-page letter. That's all it is at the front. It says, we've audited these, and we've determined that they follow GAAP. And as a result of our audit, we found that they're clean. There's nothing wrong with them. Therefore, we're giving them an unqualified opinion. Think about that for a second. Because when I was a student and I was studying the auditing part, what do you mean? I'm going to audit them? They're okay, and I'm going to tell everyone that they're unqualified? Right? Doesn't make sense when you think about it that way. Unqualified means there are no conditions that we would change to these to make them fairly presented. So there's no qualifications. We're not withholding our opinion based on any quality issues. So unqualified is a good thing. Memorize that, because I still get it backwards to this day. Good? Who's excited? People on the right side of the room are excited. Is anyone on the left side of the room excited? People on the right side of the room, we don't like the people on the left. No. Kidding. Okay. Here we go. I'm going to spend just a minute here because this is a big one. Information intermediaries. These are your financial analysts, your Wall Street gurus who look at companies and go out and make recommendations to people. Hey, so-and-so is a good buy. You know, they've got strong earnings and their stock's slightly undervalued as a result of these ratios and blah, 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 and this is what all this means, and you should go buy XYZ. Does this sound a little bit like what I'm trying to get you guys to do in the project? Someone should be nodding your head yes very strongly, because this is the project. You guys are analysts. I've given you an industry sector. You're going to go out and you're going to look at two of the top competitors in that sector, and you're going to make a recommendation based on these tools. You're an analyst. Good? Everyone should smile. You know what Wall Street analysts get paid? Hello? Okay, direct job skills here, folks. Okay, questions?
Yes.
Question?
Is a financial analyst the same as a financial advisor?
No. Analysts sit and do the digging, and an advisor sits down with the client and has a conversation. What are your goals? What are your objectives? And he'll read the analyst's report and make a decision based on what the analysts say, many analysts, to find the right thing for the client. So he's an intermediary between this guy and the client, helping guide them to make a decision on what's best for them. Okay? Okay. Now, big words. Lenders and creditors. We know about that already, right? Those are banks. A lot of times, you know, there's big company pension plans out there. Like GM had a huge pension plan before it went under and came back. What do? They go and invest that money to earn a return for the people who are going to, you know, collect a pension out of that. Insurance companies, they take in, everybody here has had to buy car insurance probably, right? You pay them money. And if you get in an accident, they send you money back. Typically more than you paid in, right? What do they do with the money? Do they just put it in a bank account and wait? No, they go invest it. So they invest in these companies hoping to earn a profit while they have the cash, and then they'll go sell the stock or whatever and then pay you out. Private investors are the shareholders. You know, this is where you or I would go down and buy a couple of shares of IBM stock or, you know, Cisco or whatever it may be. Institutional investors are big guys. Anybody here invest in mutual funds? These are smart money guys who take a bunch of people's money. They'll take everybody's money, put it in a fund, and they'll say, we're going to go invest in, and they'll have an investment plan. We're we're going to invest in high-tech stocks, or we're going to invest in, only things that return a dividend, or only utility stocks. So mutual funds are run by these big money investor guys, and they're called an institutional investor because everything they trade is in tens of thousands of shares of stock at a whack. They'll either jump in or jump out, and it will really make the market move quickly. Pension plans. State of California has its own pension plan, right? They are a big, big institutional investor. They go out and, buy a lot of stocks or bonds or other things and make investments, right? You guys hear about it from time to time in the newspaper when something goes wrong, typically. But that's what an institutional investor is. Okay. Again, I've repeated this, but it is worthy of repeating. The whole purpose of what we're doing is to we're communicating. We want to communicate information to people outside of the company so that they can make an intelligent decision on whether or not to invest in the company or lend to the company. Okay? Communicate, communicate, communicate. That's the whole goal of the financial statements. Everybody follow? You want me to repeat it again? Communicate, communicate, communicate. Okay. We talked about the characteristics before. Qualitative, relevant, timely, predictable, right? The point behind predictable is the last 5 years the company's made a profit, so I can guesstimate that next year, all things being equal, it should make a profit again. Reliability is accurate, verifiable. This is the audit part. Unbiased. I talked about neutrality before, yes? So when you're recording information or you're presenting information on the financials, like we did that balance sheet, if we wanted to, there wasn't a lot of room to play in that balance sheet, but if I wanted to present things as better than they are, and I know that my current ratio is going to be less than 1, maybe I would take those intangible assets and try and slide them up as current to bolster my ratio. That's not being neutral. That's presenting the information in a way that makes things look better than it really, really is. And that's how you're going to get in trouble. So don't do it. Okay? Neutral. Again, we want to be consistent over time so that I can compare this year to last year to next year to the year before that. And I want to apply GAAP and follow a basic set of accounting rules so that I can compare my company to my competitor, or in your case, you can compare your A company to your B company because they followed the same set of rules. The balance sheet is laid out in the same manner and has generally the same meaning, no matter which one you look at. So you can compare those two competitors. Fair enough? This is also good review. All right, we're skipping that. All right, we've talked about the annual reports. Those are your financial statements. There are how many of them? 4. They are what? In order. Which one's prepared first? No, which one's prepared first? Income statement is prepared first. Because you need net income to go down and prepare statement of stockholders' equity, right? And you need the balance of stockholders' equity to prepare the balance sheet. The 4th one is the statement of cash flows, and ending cash on that matches cash balance on your balance sheet. So there's your 4 statements. When they're published, there's always footnotes that go with them. This is what you should be working on for next week, correct? Is this the footnote week, or is the next report the footnote one? What? No, this one is just the industry and how they approach it. So the footnotes are the next one. And there's always the accountant's letter. It gets put right on the front. Here's my letter from my accountant that says I have an unqualified opinion. Right? Okay. All right. Other things that are in there, there's in the notes and in the back, there's non-financial information. Always there's a letter to the stockholders. Typically it's written by the CEO. Look at it. It kind of gives you a hint on what the company's objectives are, how it did overall in the last year. You should be reading that. Management philosophy, successes, plans for the future. Good stuff. The SEC, well, we've talked about the 4 basic financial statements, but the SEC sets the rules on what you must report, what's the minimum allowable. And they tend to favor the investor, right? Because they treat all the investors like they're not too sophisticated. They don't know a ton. So we're going to make the company present things so that a normal layperson can understand what's going on. Okay? All right. Here's some other things you'll see in an annual report. Sometimes you'll see some historical data to show trends. Look, we've been doing great for years, or we were going down for a while, but we've overcome that. And in the last 3 years, we're doing really good. The 4 basic financial statements, the management discussion I mentioned, notes, auditor's report. Sometimes you'll see recent stock price information, but you can look that up online any day, any time, right? You guys are all doing that once a week, correct? Yes. Who's doing it on Fridays? What day do you do it on? Today. Wednesdays? That's fine too. As long as you remember to do it every week. And there's also a list of directors and officers of the company in there. It's just part of it. So in addition to an annual report, all publicly traded companies are required to issue a quarterly report. Quarterly meaning every 3 months, right? So there's 4 quarters in a year. The quarterly reports are typically your basic financial statements. So sometimes you won't see a statement of cash flows, and sometimes you won't even see a stockholders' equity section. Just so you know, the quarterlies are not required to be audited. The audit is really only done once a year. But for a big company like an IBM or a GM or somebody like that, auditors will spend months and months and months out at the client site doing all the digging and analysis and looking at the information. So they'll start months before the end of the year, and because they have to finish by, the 15th day of the 3rd month after the end of the year, right, to publish. So you've got to start ahead of time. So they're checking things all the time. The annual report's called the 10K. Those of you who've been out looking have probably found that out already, right? If you go look at Edgar online, you'll find the 10K. You'll also find the 10Q, and that's the quarterly report. Oh, and this tells you when they're due. I'm nuts. That's okay. If something major happens, like the CEO leaves, or some major event happens, I don't know, meteorite falls out of the sky and blows up your factory in India, you got to report that in what's called an 8K. Okay, whenever it happens, no matter when. Questions? Answers? We're getting closer to going home. Classified balance sheet. You guys have seen this. We did one tonight, right? Assets, current assets, property, plant, and equipment, total assets, current liabilities, long-term liabilities, stockholders' equity, right? Notice this is a comparative showing this year and last year side by side. Sometimes it's very helpful to look at the two because you can see, am I doing better this year or am I doing worse? Income statement. We didn't do one tonight. But an income statement's pretty straightforward. We've all seen them. Classified income statement always shows sales, cost of goods sold, gross profit. Right? I keep using the bookstore as an example. We bought this book for $90. We sold it to everybody for, I'll be kind, $100. What's our gross profit? $10, right? Okay. From the $10 gross profit, we subtract wages, utilities, rent, all that other stuff to get income from operations. This is the income from doing the business that we're in business to do. From that, you subtract non-operating stuff like Interest expense goes down here, interest receivable, and then you get income. Then you get income before taxes, right? That's the number that you calculate your tax on. Calculate your income tax, then you get net income. Everybody follow the basic format? Basic? You're going to need to know it. I like this. It's even got more years. This year compared to last year, compared to the year before that. You can really start to see trends. Is sales going up? Well, it went up and then it went down. That would make me concerned. Profit went way up and went up even more. Sales went down and profits went up. What does that tell you? I mean, we all run around and do high fives there, right? That's good.
Margin.
What?
Margin.
Right. So, net sales, cost of goods sold gives you gross profit. Minus your selling, general, and administrative expenses, total operating, income from operations, interest and other, interest expense, gives you income before taxes, less taxes, net income. There's something down here on the bottom that's also required to be presented on an income statement. Earnings per share. Earnings per share is another ratio that's going to come up in the book, but I don't remember when. So I will teach it to you now. Earnings per share is net income divided by number of shares. So let's say we made $20,000 in profit and we have 1,000 shares of stock outstanding. What is that number? Anybody? 20. For those of you who can still do math after 7 o'clock, yes? Nobody jumped up and says, I know the answer. I mean, I got one guy who kind of mumbled it out. So we've got earnings of $20 for every share of stock that's out there.
What's in the bottom of net income?
Number of shares. Okay? So when you're dealing with a General Motors, you have maybe millions of shares as opposed to, I have 1,000 written up here. Okay? Typically, earnings per share falls into a low number, 5 cents to 25 cents typically. Depends on the company though. I did 20 because it was easy math.
Quick question that might be
Please ask.
Where
Yeah.
do you find the number of shares at again?
It will be given in the problem
Okay.
because in the real world it's way too hard to calculate. Because in the real world you use the weighted average number of shares outstanding on a daily basis. So you're adding up the number of shares outstanding every day and dividing by the number of days. So it better be given, because otherwise, yeah, I'm not doing it. I won't do that to you on a test. Okay? Other questions? Yes, sir.
How does that affect preferred shares and stuff?
You're getting a little bit ahead of us, but that's great. So, since we've elaborated on the number of shares being weighted average number, net income is the net income available for the common shareholders. Did the book cover preferred shares? Yeah, see, I forget what order the book does it in. Sometimes, we've talked about common stock, right? Everybody's good with that? That's just the stock that you buy. Sometimes there's a second class of stock, and it's called preferred stock. So people tend to pay more for preferred stock because typically the preferred gets paid a dividend first before the common stock does. Because of that, in this calculation of earnings per share, you take the net income minus the dividend for the preferred shares divided by the number of common shares. So you have to take out the money that's automatically going to go to the preferred shareholders. Okay? And I know we cover that later when we actually cover the ratio. So if you want me to really throw it all at you at once, there you go.
It's fine, I was just curious, because if you have a lot of preferred shares, then it's going to skew that number once you take it out like you did. So.
No, absolutely. You have to adjust for it. Yes, ma'am.
Just on the income statement, is the common equivalent shares same as common stock, or is that?
Yes. That's that weighted average number that I'm telling you I'll provide for you. So required presentation is earnings per share and the number of outstanding shares. Okay? Other questions? Moving on. All right. I'm going to back up. Remember I went through this net sales, cost of goods, gross profit, income from operations, and that's how much money we made from the business that we're in business to do, right? Non-recurring items are if you ever have a profit or a loss from something that other than the business that you normally are in. So we own a bookstore. I sell books every day. I buy books, I sell books, I make a profit. Well, I decide to get rid of the old manual cash register and buy a new electronic one that scans barcodes and all that cool stuff. So I sell the old one for $10. I have a $10 profit from the old cash register. Am I in the business of selling cash registers? No. It's a non-recurring item. It goes somewhere other than, it goes down below income from operations. It goes in non-recurring items. It goes in non-recurring items. Okay? Just so you understand the difference. So a normal income statement comes down to income from continuing operations, then it talks about non-recurring items. Discontinued operations would be if we're GM and we had a plant in Kentucky and we closed it, right? We're just going to close it because we're not going to make whatever there anymore, little electric cars. That's discontinued operation. Okay? Extraordinary item is something a little bit more involved, much more infrequent. This is when the Hubble Space Telescope falls out of the sky and falls into your plant in Kentucky and wipes it out. Okay? It is, I'm going to skip ahead here. We'll come back. It has to be, oh, fine, don't tell me. It has to be a combination of two things. And I know it's here. Come on. Here we go. To be extraordinary, it has to be unusual, meaning it doesn't happen to you all the time. If you live in Florida and you get hit by a hurricane, that's not unusual. If you live in Kansas and you get hit by a hurricane, that's unusual. Okay? There's a difference. And it has to be infrequent. Okay? So if you live in Kansas and you get hit by a tornado, that could be considered frequent because it happens every year. So it has to be both of those things, okay? Good? All right. Now we can back up.
What are some examples of things that have actually happened that are unusual?
Well, let's think. If you're Japanese and you run a nuclear power plant along the coast, a monstrous earthquake and a tsunami would be considered unusual and infrequent. So, sorry, that just came to mind. Right?
Like disasters?
Yes. Or, a meteorite falling out of the sky and hitting your plant would be unusual and infrequent. Are you old enough to remember the big chemical explosion in Bhopal, India? Unusual and infrequent. I mean, the whole plant just went gone. That was a bad one. Stuff like that.
Things earlier about change of ownership.
Is not considered unusual or infrequent.
It's not.
Well, if it's a corporation, so there's a bunch of shareholders, the stock trades on an exchange every day, the company doesn't record all the activity that goes on the exchange.
Okay. What about like the change in their CEO or something?
That might get disclosed in the notes or in an 8K report, but it's not going to affect your income statement directly where you report that as some sort of a gain or loss. Okay? Was there other question? Yes, sir?
Are there extraordinary items that make you money, not like a loss?
Yes. Theoretically, there could be. You know, if a meteorite falls out of the sky and wipes out your assembly plant in Plano, Texas, but it's insured for more money than the replacement cost was, theoretically you could make money off of it, but that would be unusual in and of itself, right? Okay, so earnings per share, net income divided by the average number of common shares outstanding. That's the basic earnings per share. If there are preferred dividends that have to be paid to the preferred stockholders, you subtract it from net income. Good? It is this chapter. I'm glad you remembered.
So is this for the second chapter?
This is for chapter 5.
Okay.
Yes, ma'am. We're on chapter 5. Okay? Statement of cash flows. Everybody remember the statement of cash flows, right? It tells you how much money you make from being in business, how much cash comes in or goes out from being in business, how much cash comes in or goes out from your investing activities, right? Buying equipment, buying buildings, selling old buildings, buying and selling stock in other companies. And the third part is it tells you cash flows from financing activities. I borrowed money, cash came in. I paid off debt, cash went out. It tells you all that. And then you add those 3 sections up to come up with net cash that came into the business or went out throughout the year. Good? Just remember there's those 3 sections. Operating, investing, financing. Operating, investing, financing. Okay? Yes, ma'am.
Have you done an example of the statement of cash flow on the board yet?
We showed one, but you're not going to have to do one yet, so don't worry about it. And we will work our way into them, because I think we're going to do one here in a little bit, actually. Here is an example of one. We're not actually going to do it, but I'm going to walk you through the example.
Okay, I just wanted to know if we were going to have to know how to do it on the exam.
Before we're done, you will, but not for this exam. Okay? Fair enough? So you figure out operating activities. You always start with net income, and you adjust for things that affect cash. Simple stuff. Think about it. Under GAAP, if I make a sale, but I give the customer terms, right, it becomes an accounts receivable. Did I get cash? No. So if you start with sales, you have to adjust for accounts receivable. If I have made a promise to pay a vendor or accounts payable, have I paid him the cash? No. So you have to adjust for things like that. And you derive cash from operating activities, cash from investing activities, cash from financing activities. Investing is, we bought a new building, we bought some new equipment, we sold some old equipment, we bought some stock in some other company. Those are all investing type activities. Financing activities, think about it. Borrowing money, paying off debt are the primary ones people think of. But remember, selling stock is a form of financing. It's how we get money to start the company and to run the company. So selling common stock, buying back your own common stock are financing activities. Paying dividends is a financing activity. It's like paying interest on a loan. Okay? So you get cash from each of those 3, you total it up, net increase or decrease, add that to cash at the beginning, and you get cash at the ending. This bottom number matches the number on your balance sheet, you're good to go. Yes?
The second one, acquisition of common stock.
Acquisition, you're buying back your own stock. I'm selling my stock here, I'm buying back my own stock. Sometimes companies, when they have extra cash, will buy back shares of stock because they look at it as a supply and demand sort of thing. If there's fewer shares of stock out there and the same number of people want it, maybe they'll bid the price up. So if you're company management and you're getting a bonus based on what happens with stock price, you want it to go which way? Up. Right? Okay. Questions? Anybody else? All right, moving on. We're not going to go into this right now. Because again, we're going to do a whole chapter on cash flows at the back end, and I'll walk you through all the detail. Because it's kind of involved. All right. Notes to the financial statements, supporting information. They talk about, remembering, within GAAP, we're all supposed to follow GAAP, right? Generally accepted accounting rules. Within GAAP, there are decisions to be made. For example, we can depreciate our assets, i.e. match the expense of an asset over the period where we get to use it, in different ways. And in the notes, we want to say, hey, within GAAP, here's the accounting rule for depreciation that we use. So you spell those things out in the notes. How many of you have read the notes for your companies yet? Do so, please. It will be an eye-opener. There's all kinds of cool stuff in there. And this always comes first. When they presented an income statement, sometimes it'll be a very short one, very consolidated, and they'll break it out and give you way more detail in the notes. And they'll talk about other financial things that are going on that aren't in the financial statements. Things like, here's where we're borrowing money from. Here's this great big line of credit that we have to renew. So here's what we're doing to renew that, or a revolving credit line that they just put in place to buy a new factory in Kentucky or whatever. Okay? Lots of good information in the notes. Here's an example of property, plant, and equipment. We followed GAAP, but we did straight line depreciation, and we used different lives. Buildings are between 10 and 30 years. Machinery is between 5 and 50 years. Furniture is between 3 and 5. And production molds, whatever those are for this company, every 2 years. We figure after 2 years they're no good, so we have to buy new ones. It tells you lots of stuff. If their competitor is using a dramatically different life, it'll affect their financial statements and the comparability. So you need to know this kind of stuff. That's why you need to read the notes for both companies. Okay? Questions? Answers? Who's asleep? 1, 2, I know you are. Yes, you. Yes. He gets away with it. But he wants to be here because he gets incentives for it. He's getting his car fixed for this. He's supposed to be here for the first 8 classes in exchange for getting his car fixed. He's missed 2. 8. You only have...
5 more to go.
Well, he missed 2. So there's 6. After tonight, that's 5. There's a test next week, so there's only 4 left. Lucky you. Doing a lot of texting, though. You must have a girlfriend all of a sudden. Wave to everybody, Eric.
Because I'll okay, I don't want my car fixed anymore.
No, he doesn't. Okay, so here's a great example of additional detail. Notice on an income statement, they'll just tell you net revenue, but you know, if it's a big company, they'll sometimes break it down by segment or by product line. You know, we sold this many laptop computers, we sold this many iPads, we sold this many iPods, we sold this many iPhones, right? So they break it down in different ways and show you things that you need to know that help you analyze what's going on. Okay? Questions? What's this say? Oh yeah, they talk about other stuff. Here we go. New analytical tool, return on assets. Now think about it. Company goes out and it sells stock to get cash. Why? Because they need to go buy equipment or buildings and things that they're going to use to manufacture or run the business. Okay? All those assets should generate sales, yes? Sales should generate a profit, yes? So, Net income divided by average total assets gives you return on assets. The higher that number is, the more efficient you are about running the company. Tells you how much you earn in profit for every dollar invested in those assets. Good?
Average total over what period?
Average total, beginning assets plus ending assets divided by 2.
Oh,
Okay? So if it's for a year, beginning of the year plus end of the year divided by 2. Okay? So, in this example, they're using Callaway Golf. They make golf clubs and stuff, right? Golf balls? Yeah, they do.
and gloves.
I've lost a few of those. Yeah. So in 2006, they had a 2.9% return on investment. What does that tell you? What?
It's not very good.
So for every dollar in assets, they were generating 2.9 cents in net income. Okay? In 2007, it went up to 6.5 cents for every dollar of assets. And in 2008, it went up to 7.8. Is this getting better or getting worse? Getting better, right? Cool. And then you go compare it to their competitor and see if the competitor's doing as well, or what's their competitor's trend look like. So this is a good trend that could be doing better than the competitor. That's what we're looking for. So what does that mean? That's what you're going to tell me. Okay? All right. So we just talked about asset turnover, yes? Everybody knows what net profit margin is, correct? Net income divided by net sales. We've talked about gross margin, yes? Where's my... We'll just go over here. On an income statement, Eric, come over here. We have sales, say of $100. And then we have cost of goods sold of $70. Our gross margin is 30. Everybody agree? Now, if I were doing math, this divided by this is 100%. This divided by that is 70%. This divided by sales is 30%. So I have a 30% gross margin. Okay? Then I have my G&A expenses, my other, let's say we come down to net income. My net income is 10. 10 divided by 100 is a 10% net margin. Good? So that's what we're talking about here, net profit margin. Everybody with me? Okay. Where was I? Hang on. Yeah, return on assets. Return on assets is a combination of net profit margin and asset turnover. We cover asset turnover yet? I don't think so. We're gonna. Asset turnover is average total assets, which we talked about here, divided into net sales. So notice return on assets is net income is the denominator. I'm sorry, numerator. Net income is the numerator. Average total assets is the denominator. Asset turnover is, again, average total assets is the denominator, but it's net sales as the numerator. So what that tells you is for every dollar of assets you have, here's how much sales I can generate. And this is for every dollar of assets I have, this is how much profit I generate. You look at these two next to each other and you can tell a lot about a company. But you can see how these two together, right? Net income cancels, net sales cancels net sales, and you get net income over total assets. You can see how these three are linked. Everybody good at that? You guys in the back? Does this mean I'm falling asleep and catching myself, or does that mean I'm good? Yes? No, they won't even shake their head either way. Questions? All right, moving on. This is part of what you're going to be doing for this first report, is you're going to analyze your companies and see how they choose to compete in their industry segments. And here's a couple of simplified examples. Everybody knows about this, right? We're the low-cost leader. We'll sell you this for the lowest price possible, right? This is Walmart. And then we've got high-value, differentiated product. Our product is so much better, you're going to buy ours anyway. And we're going to charge you extra for it. Anybody have an example of this? Who's this? Bloomingdale's, yeah. And think of a much more common Apple, right? Bang. But you all had great examples. So that's the kind of thing that we're looking for. How does your company choose to compete in its marketplace? And it'll be in the notes or the letter from management, and that's what we're looking for. Good? Okay. We're getting closer. Oh, we're getting really close now. Hey, Eric, we're getting close. I think he gave himself whiplash. Okay. So again, back to non-recurring items, because I want to make sure that we reiterate this so that you understand it. Non-recurring items is what? Something that you don't normally do. We're not in the business of...
Selling cash registers.
Yeah, we don't sell cash registers. We're going to sell our delivery truck. Are we in the business of selling delivery trucks? No, we make pizzas. Okay, so that's a non-recurring item. Everybody understand that when you have a non-recurring item, you either have a gain or a loss from it. Good? I'm going to make it simple. I'm going to ignore depreciation for a minute. We bought the delivery truck for $10,000. Okay? 5 years ago. We let some high school kids drive it to deliver pizzas in it every night for 5 years, and we're going to sell it today. How much is it worth? $100, right? Maybe. We paid $10,000 for it. We're going to sell it for $100. Did we make money or lose money on the deal? Ignoring depreciation, we lost money, right? So that would be called a loss on the sale of that. If for some reason we had something else, let's say, here's a much more common one. We started a small company out on North 1st Street in San Jose in the 70s. And we bought a building, right? Everybody know, right in the middle of what became Silicon Valley. We bought a building in the early 70s. And 40 years later, or however long it's been, we're going to retire, we're going to sell the building. We paid $100,000 for that building in 1972. It's worth $10.3 million now. Do we have a gain or a loss? We have a gain, okay? That is a gain from selling that building. And these show up on your income statement down below income from operations, and it goes in non-operating. Okay? Other income and expense is what this is often called. Good? Okay. Yes, sir?
What about inflation because you're talking about a 40-year period.
Well, I understand. Where in your financial statements do you recognize gains from inflation? Nowhere. Yeah, absolutely nowhere. So we record that building that we bought at historical cost, and it never changes until we sell it. Okay? Unless something extraordinary happens to it, like there's a fire, and the value of it is destroyed all of a sudden, then we would take a write-off. Half the building burns down, they saved half the building. We would write down the value from $100,000 to something less. What's it worth now? Okay, but that's unusual. So normally you record it at historical value, it stays there. Okay? Okay. So we're good on gains and losses? Okay. Extraordinary must be unusual and infrequent? Yes? And when you show an extraordinary item, it's shown net of taxes. So what that means is extraordinary items actually come down below income tax and are presented below the income tax expense. So we had there was a fire that burned down that building in San Jose, so we have a $100,000 loss. Our tax rate is 20%, so we got a benefit because of that. We don't have to pay taxes on $100,000 in income. So we would show loss of building San Jose, $80,000 loss, net of taxes. Good? Okay. Oh, look, here we go. Revenue, cost of goods sold, operating income. Other income, interest expense, income from continuing operations. This is what we're in the business of doing. Income from discontinued operations. These are your other items. And here's your extraordinary item, building burned down, net of tax. Good? Everybody follows the presentation where they go way down below. Yes? That was high? Thank you. Okay. Net of tax, net of tax. And that, ladies and gentlemen, is all of that. Don't turn that off yet. Now, I'd like to sit and answer questions, otherwise referred to as you're torturing me. But questions, anybody? On any of this? Yes, sir.
For the exam next week, we need to be able to prepare a balance sheet and an income statement, adjust those two, or what else?
Yes, you will see a balance sheet and income statement. You'll be entering things in T accounts, so you'll be analyzing transactions, and you will most likely do a trial balance. Okay?
So we'll have to be able to go from like a general ledger with T accounts to a trial balance to a
Income statement.
classified balance sheet.
And income
For
statement.
all that, be able to prepare an income statement.
Correct. Okay? Don't forget the online exam. I'm going to turn it on in the morning. Any hour you want between now and 6 p.m. next Wednesday night is your time to do that. I think I give you more than an hour for it, so plan on a little bit more. And that's going to be multiple choice questions based on if you read the book or not. Most of which I've told you here, but there could be a few stray questions that I didn't cover. Okay? Other questions? Questions on the project? If I don't get them now, I will get a ton of emails, probably Saturday or Sunday. My office hours are the hour before class on Wednesday nights in this room, and the hour before class on Thursday nights in the C building in Watsonville. Sometimes people like to show up, right? Yes, ma'am.
So it is in total 5 pages for the entire thing?
Okay. I've had people turn in 40-page projects, okay? Don't do that. Okay? Be concise. Spell it out to me in 5 pages. If you have graphs, charts, or photographs, that's not counted in the 5 pages. Okay? Because I can read pictures pretty easy. Good? All right. Other questions? Yes, sir.
You need to know the ROA and EPS.
You will need to know the ratios. That's correct. Return on assets, earnings per share, current assets, current ratio. Sorry, current ratio is current assets divided by current liabilities. Okay, good question. Yes, anyone else? There's one obvious question left.
Wait a moment.
That's it. And the answer is yes.